So our first lecture is just going to be a review of financial accounting, as it were. If you've taken financial accounting recently, then sit back, relax, and let the info flow over you. Otherwise, if it's been a while, this will sort of catch you up to speed on what you should know up to this point before we can get started with the managerial accounting, okay? Um, Trust me, there will be managerial accounting coming up soon, okay? We're just doing this quick review first. All right. So, the first thing we're going to do is run through the different financial statements, okay? Keep in mind, um, the transactions are any sort of economic interchanges between entities that are accounted for and reflected in the financial statements. So anytime money changes hands or the promise of money, there will be something that impacts these financial statements. Okay. So you've got your transactions, then we sort those and classify them as various accounts. Okay. And then we decide how we want to present those numbers. Okay, that is our accounting system, our accounting procedures. Okay. Um, those two things together, the sorting and classifying and our interpretation, that creates the financial statements. Okay. Um, every single time there's a transaction, we make a journal entry, but all of that goes into an account, okay, which is kind of the summary of everything that's happened. Okay, the account is a record in which those transactions we talked about affect various assets, liabilities, and stockholders' equity. Remember our accounting formula, okay? And by extension, also revenues and expenses, okay? Um, the accounts all are kept together in the ledgers, right? And the summary of the ledger is the financial statements, okay? Um, Keep in mind that we have required disclosures for our financial statements. All right. Um, this is our list of required disclosures. These are things that absolutely have to be in the financial statements no matter what. And these are the financial statements in which you would find this information. Okay. Um, so when you put all the financial statements together, the balance sheet, the income statement, the cash flow statement, and the stockholders' equity statement, we call this the annual report. Okay. It also includes notes to accompany the financial statements. That's any additional disclosures that we need to make in our financial statements, okay? And we also have management's discussion and analysis where they talk about the overall financial condition of the company. Um, so here we see the parts of the balance sheet again. These reflect our accounting equation. Remember, assets equal liabilities plus stockholders' equity. Okay, so we've got our assets here. We have our liabilities and stockholders' equity together. They equal the total assets. Here again is our accounting formula in its simplest form. Okay. Um, and here we're just describing what each line item on the balance sheet is. Okay. So this is a refresher. Accounts receivable. That is cash owed to us by our customers. Okay. Our inventory, that's everything, all our merchandise that we have bought or made but haven't sold yet. Okay. Equipment, as in property, plant, and equipment, that's a fixed asset. That is some large tangible asset that we use in the normal course of business. Okay, and remember, we depreciate the long-term assets using depreciation. Okay. Um, Short-term debt is anything that we've borrowed that will be paid back within 1 year. Okay. And then accounts payable is what we owe our suppliers. Okay. Um, and then we have other accrued liabilities. Here they talk about creditors, but that can also be payroll that hasn't been paid out yet. Remember that um, we pay our employees at the end of a 2-week period, for example, but Monday they worked, Tuesday they worked, Wednesday they worked. We owe them money for each hour that they work, and we accrue that until we pay it out, and then it becomes an expense. Okay. Long-term debt is anything that's not going to be paid back within 1 year. And then the stockholders' equity um, is whatever is left to the owners of the assets. I'm sorry about that. That's my client line going off. I promise it's not one of you. Um, anyway, stockholders' equity, that is after we subtract the liabilities from our assets, what's left over that belongs to the owners, the stockholders of the company. Okay. So here is just words in pictures. Okay, we're pointing out each of these items that we defined on the last slide and where we find them on the balance sheet. Remember on the balance sheet that we list our assets in order of liquidity. That's how quickly we can change those into cash. Okay, and then liabilities are listed in the order of how soon they're going to come due. Okay, now the income statement. All right. We have our revenues, okay, which in this case we're talking about a sales company. So their revenue is in sales. All right, then we subtract out the cost of goods sold. That gives us the gross profit or margin, sometimes called margin. Then we subtract out our general and administrative expenses to get our income from operations. Then we take out the other stuff, interest, taxes, things like that. Okay. And then we come down to where we have our net income. That's what we made this year. And it can be a loss. Okay. If we lost money. In this particular presentation, they have divided this income on a per share basis. So each shareholder owns $1.80 per share. Okay, so some definitions for the income statement. Remember, net sales are the amount of sales to customers minus any customer returns. All right, costs of goods sold, those are the things that we purchased for inventory that have been sold. All right, and the difference between those first two is gross profit. All right. Selling, general and administrative expenses, those are our operating expenses. And income from operations is when we subtract those additional operating expenses out of gross profit. Okay. Interest expense, that's the interest that we're paying on borrowed funds. And then income taxes, sadly, we all know what that is. Okay. It's usually shown on the income statement after all the other costs have been computed. Okay. And then earnings per share of common stock outstanding, we just take that profit or loss at the bottom line and divide that by the number of shares outstanding to get that number. Okay, here is the statement of changes in stockholders' equity. This is a startup company, so the beginning balance was 0. Okay, usually you will have a beginning balance that carried over from last year. And then we include whatever additional capital our owners have paid in, our profits or loss for the year, and then we get our ending stockholders' equity, which will become the beginning stockholders' equity for the next period. Okay. So again, some definitions for you guys. All right. Paid in capital, we talked about that. Okay. That's the total amount invested by the owners. Common stock is the number of shares that have been authorized and issued to stockholders. Okay. Additional paid in capital is anything extra that owners have paid in over the par value of the stock. All right. Retained earnings, that's the amount of net income that has been retained for the use in the business. So we have that net income on the income statement. We can decide whether we want to keep it to grow the business or whether we want to pay it out as dividends to our shareholders. Okay. Those are distributions of our earnings. The income minus the retained earnings gives us the dividends paid out, or vice versa. If we subtract the dividends from our income, we have what's left over for us to spend on the business. Okay, statement of cash flows. Remember, that only looks at the transactions that impacted our cash for the year. Okay, and it's broken up into 3 parts. We have cash flows from operating activities. That's our day-to-day cash flows. We have cash flows from investing activities. Those are those cash transactions that impact our long-lived assets. Then we have our cash flows from financing activities. Okay, those are our interactions with our creditors and our shareholders. Okay. Then remember, GAAP requires us to do an indirect presentation of our statement of cash flows. So we have to take our income statement and then back out any transaction that we've recorded there that doesn't directly impact cash. Okay. So remember that each one of our financial statements covers the entire year except for the balance sheet. Our balance sheet is the snapshot of that very last day of the period. Okay. And this next part is just showing you the accounting equation in action. Also, how you use the accounting equation in order to back out your various accounts in order from the income statement in order to express them on the statement of cash flows. Okay, so as we learned in our basic accounting class, all of our financial statements play into each other. Okay, so our net income goes into stockholders' equity on our balance sheet. And our income statement and balance sheet are both used to generate our statement of cash flows. Words and pictures. This is a model of how the different balances interact with one another on the financial statements. This is our beginning of year balance sheet and end of year, or not the year, but period. Beginning of the period, ending of the period. So that you can see the changes in the balance sheet and how those impact the statement of cash flows. Okay. All right. Then just keep in mind, you can use basic algebra to move around the values in the accounting equation. So it's generally presented as assets equals liabilities plus stockholders' equity, but it can also be assets minus liabilities equals stockholders' equity if you needed to solve for that. Okay, so a few um, assumptions that we need to make going into both our financial accounting and our managerial accounting. We need to assume that our business is a going concern. That means that it will continue on in business after the current period financial statements. Okay. Also, remember that we present all of our information on the balance sheets in currency. Because we're using US GAAP, we present them in US dollars. Okay. Um, Remember your matching principle and your revenue recognition principle. Okay. Revenues and expenses have to be matched together. Okay. So at the time of sale, because we're recognizing that cost of goods sold, we also have to recognize the sale, even if we don't receive cash. Okay. Even if it's on credit, if we're offering credit to the customers, we still recognize that as a sale. Whereas expenses are recognized when they're paid. Okay. So an account payable, if we're getting credit from our supplier, we don't recognize that as an expense until we actually pay it. Okay. Um, Remember also another assumption that we're going to make is that each item on our financial statement can be separately identified and accounted for. Um, let's see, the cost principle I talked about. Oh, transactions are to be recorded at costs, okay, and in dollars. All right. Um, as accountants, especially with managerial accounting, where we are making projections and estimates, it's always important to maintain our objectivity. Okay. Um, the accounting period. All right, this is the time period that our financial statements cover. Okay, it can be a year, it can be a quarter, it can be a month. Okay, it really depends on our own accounting cycle. If you are a publicly traded company, the SEC says you must have financial statements out at least annually. Okay. I talked about matching revenue and expenses. Revenue is recognized at the time of sale, expenses at the time they're paid. And we call that accrual accounting, okay, where we're matching our expenses with our revenues. Okay. Um, Remember that we have to be consistent with our accounting rules. We can't switch um, to LIFO when it's convenient or change the way we recognize the way we depreciate our assets every year to make our financial position look better. Okay, we have to pick a um, accounting system and stick to it. Okay, full disclosure, anything that might impact our shareholders' decisions, we have to disclose it. Okay, if it doesn't have a specific line item on our financial statements, that's what the notes are for. Okay. Um, Materiality. Okay. You can comb through your accounts and make sure that every single dollar value is absolutely accurate to the fraction of a penny. But really, what is the value in that? Okay, we need to make sure that as a whole, our financial statements are fairly stated, but they don't have to be, I shy away from saying they don't have to be 100% accurate. Of course, we want to try to make them as accurate as possible, but we want to weigh the need for accuracy against the need for timeliness. Okay. So we always want them to be fairly stated, but we want to make sure that we're not nitpicking every single penny. Okay. Um, the flip side of that, of course, is our notion of conservatism. Okay. When in doubt, um, always, and sometimes we have to make estimates, okay? We're not 100% certain, but when in doubt, always make profit lower and expenses higher, okay? Just to make sure that we're not misleading people, okay? Give them a darker picture rather than giving them a rosier picture than reality. Okay, so just giving you that example of accrual accounting versus cash flows. Remember when we were talking about the different financial statements, we said the statement of cash flows only recognizes when cash changes hands. Okay. When we have cash basis accounting, we recognize our revenue when the cash is received. And we recognize um, our expenses when they're paid. Whereas with accrual accounting, okay, we recognize the revenue when it's earned. All right. So if someone prepays us and we haven't performed the service or given them the product yet, that's a liability in accrual accounting. But in cash basis accounting, we record that revenue as soon as we get that cash in our hands. Okay. Why do we even talk about cash basis accounting? Remember, we are only tied to GAAP if we have publicly issued financial statements. If you're a mom and pop shop, your aunt selling jewelry on Etsy, more likely than not, these guys are doing cash basis accounting. Okay, they don't have to worry about SEC regulations. They're not a publicly traded company. Okay, so I did say that we try to make our financial statements as accurate as possible, but there's some things that they are not able to provide us, okay? As a general rule, they can only give us quantitative data, all right? They don't give us the qualitative details, okay? Um, this is changing a little bit in modern presentations. So, if you look at financial statements nowadays, especially in the management's discussion and analysis, this is a part where they can disclose a lot of their positive policies. Also, a lot of companies have ethics reporting. Okay, they talk about their environmental impact or their inclusion policies. Okay, so these are items that more and more often we're seeing them show up either in the discussion portion or in the notes portion. Okay, but at this time, there's no requirement to disclose that you're a horrible person or that as long as you're not doing anything illegal, you don't have to disclose that you have sort of shady business practices. Okay. Um, remember more assumptions here. We have to value our assets at cost, okay, not at market value. Um, and then because of the matching concept, oftentimes estimates are allowed here, okay? Um, depreciation, that's not 100% certainty, okay? Warranty costs. Remember, back when you did basic accounting, we learned about how this is an estimate that's based on prior data. Okay. Again, the financial statements don't have to be 100% accurate. You should put some effort into these estimates, but it is understood that they are estimates. Okay. And then again, the annual report. That is all the financial statements together. Um, with our management's discussion and analysis, the notes to the financial statements, and if you're a publicly traded company, you also have to include an auditor's examination of those financial statements. They will look both at internal controls and also whether the financial statements are fairly stated. That is the end of our review data. Okay. Apologies in advance if you've just taken the basic accounting course. I had some people, oh, poor things. They were taking accounting at the same time as this class. So they're they were pretty much getting a double whammy on this information at the same time. So I hope that this review is helpful to you. If you have any questions at all, please reach out to me. I am available live during our class time to answer questions. I just provide this lecture outside of that time in case you don't have the full 3 hours to sit there and listen to me babble on during the appointed class time. Okay. Best of luck to all of you and take care.